What if I told you that one simple decision in 2026 could quietly slash your age pension, even if you've worked your whole life and own your home outright? Right now, thousands of Australian seniors are walking straight into Centrelink traps without even realizing it. And the scary part is, most people think their home keeps them safe, but under Australia's updated pension rules, that's not always true anymore. If you're planning to downsize, help your kids financially, move into aged care, or even sell your family home, this video could save you thousands of dollars and a massive amount of stress. Because today, I'm breaking down the biggest pension mistakes Australians are making in 2026 and how you can protect yourself before it's too late. Hello everyone, welcome back to Centrelink Info AUS. I'm Daniel Brooks, and on this channel we help Aussie seniors, pensioners, and retirees understand the real Centrelink rules that affect your money, your retirement, and your future. We keep things simple, practical, and easy to understand because, let's be honest, Centrelink rules can get confusing very quickly. So if you want clear updates without all the complicated jargon, make sure you subscribe and stay connected. Now, one of the biggest misunderstandings Australians still have in 2026 is this idea that your home is completely protected under the pension system. Technically, your principal home is exempt from the age pension assets test. That part is true. But what many people don't realize is that homeowners actually face stricter asset limits compared to non-homeowners. In other words, if you own your home, Centrelink allows you to hold less in savings and investments before your pension starts getting reduced. That's where the danger begins. For many Aussie retirees, the family home is their biggest asset. And once you start making changes involving that property, whether it's downsizing, selling, gifting money to your children, or moving into aged care, Centrelink can suddenly reassess your entire financial situation. Let's start with downsizing because this catches so many people off guard. Imagine you sell your longtime family home for $900,000. Then you buy a smaller home for $600,000 and keep the extra $300,000 in the bank. Sounds sensible, right? But here's the issue. That extra money now becomes an assessable asset under Centrelink rules. If your total savings and investments move above the pension threshold, your payments could be reduced significantly or even stopped altogether. And many Australians only discover this after the sale has already gone through. Now yes, Centrelink does provide temporary exemptions if you plan to purchase another home within a certain period. But during that time, deeming rules may still apply, meaning Centrelink assumes that money is earning income even if it's sitting quietly in your account. That assumed income can still affect your pension entitlement. This is why timing matters so much. Another major trap in 2026 is gifting assets to family members. A lot of older Australians want to help their kids or grandkids, especially with the cost of living crisis and housing affordability issues. Some transfer money, others hand over part ownership of a property, and some even give away large sums after selling their home. But under Centrelink gifting rules, giving away assets does not automatically remove them from your assessment. Centrelink has deprivation rules, and those rules can continue counting gifted assets for up to 5 years. So even if the money is gone from your account, Centrelink may still assess it as if you still own it. That means your pension could still be reduced, even though you no longer have access to the money yourself. This is one of the harshest surprises many retirees face. Now let's talk about aged care because this situation can become very emotional for families. When someone moves into residential aged care, people often assume the family home remains exempt forever. But that's not always the case. In many situations, the home may remain exempt for a temporary period, but once that time frame ends or the property is sold, the proceeds can suddenly become assessable assets. That can impact not only the pension but also aged care fees and contributions. And with updated aged care reforms now fully operating in Australia, many families are discovering that poor planning can lead to higher costs than expected. Some people end up asset-rich on paper but cash-poor in reality. They have value tied up in property but struggle with day-to-day living costs. This is why proper advice before making major retirement decisions is absolutely critical. Now, another issue many seniors are noticing in 2026 is the impact of deeming rates. Even if your investments are not earning much interest in the real world, Centrelink still uses deeming rules to estimate how much income your financial assets should be generating. That estimated income can reduce your pension payments. And here's the scary part. Some pensioners only discover there's a problem during a review. Then suddenly they receive a letter saying they've been overpaid and now owe money back to Centrelink. That can be incredibly stressful for someone living on a fixed income. So what should you actually do to protect yourself? First, Take time to understand your current financial position. Sit down and calculate all your assessable assets. That includes bank accounts, shares, managed funds, superannuation, investment properties, vehicles, caravans, boats, and anything else of significant value. Then compare your situation with the latest Centrelink asset thresholds, because those thresholds can change several times throughout the year. Second, before making any major financial move, speak with a licensed financial advisor who understands retirement income and Centrelink rules specifically. Not every advisor specializes in this area, and the wrong advice can become very expensive later on. Third, always report major changes to Centrelink within the required time frame. Selling assets, receiving inheritances, changes to investments, rental income, or superannuation updates can all affect your payments. Failing to report changes can lead to debts, penalties, or serious compliance issues. And if you're part of a couple, remember this clearly. Centrelink assesses couples jointly. It doesn't matter whose name the assets are under. The combined financial situation is what matters most. Now, I also want to clear up something important because there's a lot of fear online right now. The government is not coming to take your house. Centrelink is not secretly trying to seize homes from pensioners. But the rules surrounding assets, deeming, downsizing, and aged care are becoming more complex. And everyday Australians are making costly mistakes simply because they don't fully understand how the system works. That's the real risk here. The biggest danger is making emotional financial decisions without knowing how they affect your pension long term. So before you sell a property, gift money, move into care, or make major retirement changes, slow down and get proper advice first. One conversation with the right professional could save you thousands of dollars and years of financial stress. And most importantly, stay informed. Because the rules continue changing, thresholds continue updating, and unfortunately, many seniors only learn about these issues after the damage is already done. If this video helped you understand the 2026 pension changes a little more clearly, make sure you give it a thumbs up because it really helps the channel reach more Aussie seniors who need this information. And if you haven't subscribed yet, join us here at Centrelink Info AUS for regular updates on Centrelink payments, pension changes, retirement rules, and important financial news affecting Australians. I'm Daniel Brooks. Thanks so much for watching, and remember, staying informed today could protect your retirement tomorrow. Take care, stay safe, and I'll see you in the next video.